Very good morning to all of you. Okay, so I'm going to try and talk about financialization of the economy, but the other aspect of financialization that I've also been asked to speak about is how that impacts investment behavior among households in the country. So that's another part of the topic that I'm going to try and cover. So first, let's get started with financialization and what's going on around, around the market and what you see every day. I started off with the fact that I think many of you would have maybe come through some days of yesterday and today about looking at equity outlooks, debt markets, what's happening to currency, what's happening to global volatility. But really as an investor, and especially as an individual investor, I guess the key question for all of us is, what is my actionable from all of this? What should I do from here? And of course, knowledge is very important, but there are other aspects that we should also think about. And that's, again, something that I want to try and touch upon. So to start with, I want to ask you a question. Think about your net worth today, and for a minute, if you can, do the mental math of how much of it, out of your net worth, is in what is called real assets or physical assets, which is land, gold, art, wine, whiskey, whatever else that you've got in tangible form, and how much of it is in financial assets, which is shares, securities, debentures, deposits, currency for that matter. Just take a moment and get that number. What's the split for you? Yeah, everyone's got that number broadly? The other question I want to ask you is, over the last 7 years, has that undergone a change for you? Just think about it. Have you moved in favor of financial assets or in favor of physical assets? In general, if I can do a show of hands, how many of you have moved in favor of financial assets? If I can see a raise of hands. Okay, probably 100% of the room. Okay, which is great, and we'll talk about a few numbers, but I want us to reflect upon that also because India for a very long time has been the mecca of physical assets. I think all of us growing up had this conventional wisdom passed through that beta, whatever you do, get yourself a house and, whenever you can every year, and there are celebrations and there are festivals that allow us to almost do a very regular investment into gold and jewelry and precious stones, etc. So make sure that you've got real estate and you've got some amount of gold and jewelry. And that's been conventional thinking probably for, 2,000 years in the country. That makes us an incredible consumer of gold, the largest in the world. We've got, almost close to $1 trillion worth of gold among households, not with the RBI, lying with us. It's an incredible amount of wealth that we have in gold. And that brings us to one point I want to leave behind. Now, here's a picture. You probably see a hospital bed from some years back, and you also have this nurse offering the patient something. This is the 1940s in the US. That something which may not be very clear is actually cigarettes. So conventionally, if you were to rely on convention, it was absolutely fine, not too far back, to offer a patient some cigarettes while he was recovering in a hospital. That's convention for you, that's not always the way we live today. There's another one. It was perfectly fine to have a whiskey dispensing machine in office. This is again 1930s or 40s in the US. Those were the days, right? I think the point I'm trying to move on to is the fact that I think finally it seems like this love for physical assets seems to be getting more moderated. When I say moderated, it has always been more than 50% of how the Indian household saves, and it has finally come down to a trend that we think is maybe a bit real. So what you now have is at least half the money that an average household saves comes into financial assets, firstly. This used to be as low as 20% and then 30% and then finally in the 40s for the longest time. So there's a big move that's already going on, and that generation after generation is getting stronger, where the conventional wisdom of holding everything that you have in real estate and gold and jewelry, etc., is getting challenged. And that's something that we think is likely to continue. Now, what everyone has done over here is actually reflecting up in these graphs. So, if all of us in the room have moved in favor of financial assets, that's what India has done as well. What India is also doing is that within the sphere or the pie of financial assets, if you look at the split up, of course, there is currency deposits, shares and debentures, and many others, including provident funds, etc., contractual and retirement savings, which is the bulk of the savings. But if you look at the slice, which is shares and debentures or securities of any kind, including mutual funds, used to be just 2%. Now keep in mind, this is 2% of the less than 50% of total savings, which used to come into shares and debentures. So everything that we do is actually compressed within that 2%. That's actually grown 4 times. So the other trend to keep in mind is that not just our financial assets within overall savings going up, but within financial assets, the share of shares and debentures and mutual funds or securities, capital market products, has gone up about 4 times. But it's still a long way to go. It's still sub 10%. So that's the sort of move that one should think about when you look at financializing. Now, of course, that has resulted into a pretty happy situation for all of us in the mutual fund industry, where you see that average assets have been going up year over year, compounding at about 23% over this period. So over the last 7-8 years, that's the rate of growth we are seeing. Now, what happens because of this is, keep in mind, this is now contractual savings coming finally to capital markets, which has been deprived to a large extent of capital. So companies get finally some capital and therefore a more stable source of funding their aspirations. And that, of course, drives up economic growth. So on the whole, therefore, this move, allowing you to fund growth, becomes a far more stable form than many other forms which may include dependencies. Now, the other interesting thing that we must keep in mind is that while this is the asset, what's actually very heartening is the maturity that we see in the retail Indian investor now. And a good proxy for that is the SIP flows in the mutual fund industry. SIPs, I'm assuming you know, are systematic investment plans. It's a contract that you make or a pledge that you make to, on a regular basis, put aside some money into a scheme or a fund. Now, despite the volatility that you've seen in your portfolio, and I'm sure all of us have had some issues or the other with our fund managers over the last year. I think I saw a few of those questions to Kenneth earlier. The fact is that the conviction which you would not normally see in previous cycles is what we see in the graph today. So if you look at this graph, the fact that the Indian investor is continuing to increase, not decrease, his monthly commitment to an SIP is telling us about whether we are past the tipping point or not. And to us, we do believe that we are now past the tipping point. This is now getting into mature investor behavior, where despite volatility, people are willing to commit more money to come into financial services. And you're seeing the 2% go to 8% already. The 8 to 16 to 20 is a natural outcome of how this moves. So to summarize, I think we do believe that financialization is here to stay. There are many factors that are talked about of why that has happened. Demonetization is maybe one of them, but it's not the only one. There is also the ecosystem of the banking system, the Jan Dhan system, which is giving people bank accounts, which means that people have money in a form that is easily transferable and can be accounted for. There is the entire Aadhaar and mobile, the JAM trinity, which is getting people into digital platforms. And once you're on the digital platform, making an investment or taking a loan becomes so much more simpler. So access is another very large part of why this is happening. Now, I did mention that one part of my goal today was to just talk a few things about financialization, but the larger part of my goal is really to talk about the second aspect. And the second aspect is really around investment behavior. Now, I'm sure between yesterday and this morning, you've got a lot of great inputs, great knowledge about where to invest, what's happening to cycles, what's happening to earnings, how are sales trends looking, etc., right? But I do want us to maybe look at a few illustrations, a few stories, if that's okay, and reflect a bit on what are we really doing. I'm in the mutual fund industry, and in most financial industries, you have to start off with a disclaimer. So here's my disclaimer. These might be fictional. If there are any resemblances, please pardon me. But I think on a more serious note, some of these illustrations tell us something which I have found quite profound and something I still carry with me even today. And that's why I thought this morning, maybe as we get started with the day, it's something that you might want to reflect upon. Anyone recognize this gentleman? Sorry? Newton, yes, that's absolutely right. So this is the great Newton, considered by many to be among the best intellectuals the planet has ever seen. Physicist, mathematician, the laws of motion, as we all know, calculus, astronomist, etc. Yeah. But Newton also was an investor. And I think somewhere around the early 1700s, about a decade before he finally passed, he bought a company called a South Sea Company. And the South Sea Company did very well. And in a very short period of time, this company actually doubled his investment. And Newton said, okay, this is something that has given me the yield that I need, and I'm going to exit. And he exited that investment. He'd made a nice profit. It had met his target. He doubled his money. The South Sea Company continued to do very well. And it reached a level where Newton was finally forced to get back into that investment at a much higher level than he had exited. I think most of us guess what happened, which is that was probably the peak of the bubble that company valuations were seeing. And Newton, in that one investment, lost pretty much a large part of his net worth. Newton famously said that I can calculate the motions of heavenly bodies, but not the madness of people. And of course, Ben Graham later on said that the investor's chief problem and his worst enemy is likely to be himself. Now, this is a story which is dear to my heart, because when I was studying commerce many decades back, the one takeaway I had is that intelligence doesn't mean investment success. So I can have a job in the investment world, so I don't need intelligence. And that's something that we have to also think about, that the best of brains in the world can make mistakes when they get too led by what's happening around them. And a good decision could be overturned because of the noise in the market. I want to share another similar but dissimilar illustration with you. Just after the global financial crisis, when we were just going through recovery, 2010 or thereabouts, in a very short period of time, there are two notable newspaper articles. One was around this lady. This lady, Grace, had lived a pretty unremarkable life. She had been orphaned at 12. She had somehow managed to get herself a job after some basic education, which the state provided. She was a secretary for the rest of her life. She lived in a one-bedroom apartment, never married, never had children, pretty much, quiet existence. Till the newspaper article actually highlighted the fact that she had left her savings across to charity. The value of the savings was $7 million. So of course, it became newsworthy, saying, how's this secretary, not heard of, been able to generate that sort of wealth? What's going on? And they did the analysis and then figured that all she was doing is riding on the power of compounding, investing in the markets for almost 75 years. And a very meager saving that she had actually compounded to almost $7 million. So that's grace for you. On the other side, there is the gentleman who was also in the news because he had just filed for bankruptcy. Robert was a pass out from Harvard. He'd done his master's in the University of Chicago. He was the vice chairman of a very famous investment bank looking after the entire LATAM business. At mid-40s, he wanted to retire, like many of us wanted to, and read the rest of his life in comfort, luxury, see the world, and do what he always wanted to. He was filing for bankruptcy in 2010 because he was not able to, and he was fighting for non-foreclosure of his two large homes. One of them was 20,000 feet with a mortgage running, I think, $60,000, $70,000 per month. I think the point here is not how Grace used compounding and Robert spent his savings in real assets and pursuing things that were not really, maybe productive after his retirement, which is early. I think the larger point we have to think about is that this is the only industry or business, investing, where knowledge or prior knowledge, which Grace did not have, industry connections, which Grace did not have, or any technical know-how or a degree, did not matter in the eventual outcome. Think about any other industry where a Harvard and UChicago educated person would be at a disadvantage in terms of finally what he achieved in life versus a person who hardly had any education and spent the life just being a secretary. So that's, again, a real, thought for us, which is in this business of investing, it is not the know-how, it is not the knowledge, it is about behavior. And often, that is the part which we are most ignorant about. What are we actually doing? So we can go around collecting all the knowledge, like Robert did, and use it up. But our outcome may not necessarily be better because it is about behavior. This is a formula you would have always seen, but study after study after study tells us that it's actually the R that we are most focused about all the time. So I'm sure you've had your arguments with your Kotak Securities RM or counterpart about that 1 basis or 5 basis beta that you need. And we are ignoring the compounding function, which is T, which is where real investment or real wealth comes from. Now that's also not very rare. And again, Jin Rohn has said the same thing, which is you don't have to be extraordinary in this business. What you have to do is be ordinary, but do it extraordinarily well. So it's all about, again, going back to the process. Many of you, and I did grow up reading Jataka Tales and Panchatantra and all of these nice comics. I don't know if you remember this tale about a Brahmin who was carrying his goat on his neck, taking the goat to the market to try and sell it. He needed some money. And there's a band of thugs, bandits, who knew about this. And they say, okay, let's try something on this Brahmin, on the Pandit. So the first one comes to the Pandit and says, why are you carrying this dirty little dog on your neck? So Pandit said, can't you see, madman? This is not a dog, this is a goat. So no, it's a dog. He said, no, it's not a goat. And the Pandit just moves on saying, what a mad guy. After some time, the second bandit comes down and says, hey Pandit, why are you carrying this pig? Aren't you ashamed of yourself? You're a Brahmin, you're carrying this pig on your neck? He said, no, this is not a pig, this is a goat. Can't you guys see? Said, no, this is a pig. So Pandit is now saying, what is going on? And he shrugs it off, moves on again. The third bandit comes in and says, Pandit, aren't you ashamed? You are lugging a dead calf on your neck. Aren't you ashamed of this? Pandit said, what is wrong with this? This beast seems to be keeps changing its form. I thought I started off with a goat and now there is a dog and then there's a pig and then there is now a dead calf. This must be some demon's work. Let me get rid of it. He throws the goat and runs away. The moral of the story is that you are not right or wrong because the crowd disagreed with you. You are right because your data and reasoning is right. Just because 3 people told us what you were doing is wrong doesn't make it wrong. And I think many, many years back, the same stories come and haunt us, doesn't it, in investing. So conviction can be very difficult to maintain when times are volatile. And that's again one thought that I thought I'll leave with you, that it can be very easy when things are so volatile to believe that what you're holding in your portfolio is not a goat but a dog or a dead calf even, and get rid of it, throw it away to the thugs. And I hope you don't do that. It's also difficult because we're getting bombarded all the time with news channels which are telling us humongous amount of things which are interesting and important, but really the question is it important for you? What are you going to do about it? Someone said that, now in a day, we receive more data than people in the 1900s used to receive in a lifetime. With so much data coming through, it can be very difficult to ignore all of these noises, these thugs which are coming and saying things about your portfolio, or the crowd which is swaying Newton to say, look, buy this back again. And that's why it comes back to what is your behavior? What do you want to do? Like Soros says, if you find investing entertaining, you're probably not making money. Good investing is boring. So it is about buying something and holding on almost forever. And if you like the sort of adrenaline flow from investing, then please watch out. I want to conclude with my last story, and this is about a hat seller in a village. The hat seller has had a long day. He just wants to rest for a bit after lunch, and he decides to take a nap under a tree, and he leaves his bag full of hats next to him. When he wakes up, he finds that his bag is gone. And there's a bunch of monkeys on the tree which are playing around with the hats from his bag, and the hat is, again, his bag is lying around somewhere, empty. The hat seller is obviously distraught. So he waves at the monkeys and, asking them to give it back. They wave back. He yells at them. They howl back. He throws stones at them to get that's his livelihood. What does he do for the day then? The monkeys throw some fruit back at him. Finally, it strikes to him. He takes his hat, the one that he's wearing, and throws it on the ground. What do you think the monkeys did? They throw all their hats on the ground as well. He collects all the hats, puts it in the bag, and goes away. So he's saved. Many years later, now this is a time, of course, when people follow in their parents' footsteps, so his grandson is now the hat seller. And the grandson is now, again, tired after a morning full of trying to sell his hats, goes to the tree, the same tree, takes a nap in the same way, and presto, he wakes up and he finds that his bag is missing and hats are all over the place with the monkeys. The grandson is obviously intelligent. So he says, oh, actually, I know this. So he throws a few pebbles, the monkeys throw some fruit bags. We said, yeah, it's working now. So he takes his hat, throws it onto the ground, and he's waiting. One of the monkeys scampers down, takes that hat also and runs away. And he's looking quizzically at the group. And the leader of that monkey brigade says, my grandfather also told me this story. Point is that if we are all looking at history to tell us what to do for the future, as Buffett says, the richest people would be librarians. So I do want to conclude with a few key takeaways. We should look at your allocation and look at how uncorrelated these assets are in your portfolio. That may be one of the cornerstones of your investment strategy. Often, we like to repeat this because too few people we find pay deep attention to this. A lot more time is spent on what is really at the fringes, which product and how much fees and what's the exact weightage, etc. The second is that we spend a lot of time enhancing our knowledge, which is important, but we may not be spending as much time controlling our emotions and our behavior, which study after study after study tells us is far more important in investing than the charts and the graphs. So think about Grace and think about Robert when you look at behavior. Just good, ordinary behavior, but consistent and disciplined over time in this business can give you a far better result than being the most educated and the smartest person on the block. And to keep your emotions at bay, and as someone has said, behavior is very difficult. You're almost immune to your own behavior because you don't see it. So my bad behavior at home is reminded by my wife. In office and when I'm investing, my advisor does that job for me. So you do need someone independent and someone who can act as a mirror for you to tell you about whether the investment choices you're making are actually in your favor or are there any mistakes or traps you're falling into. Thanks for being a wonderful audience and a patient audience. Thank you.